Hey guys, Brian Stevens here over at Mortgage Shots, also the National Real Estate Post. Hey, listen, we're going to be talking a lot about what's going on in real estate and mortgage lending today and things that we could do to go ahead and improve our output. If you like what we're doing, just make sure you hit like. That kind of helps out what we're doing. And feel free to share this with any and everybody that is also concerned about the state of real estate. So let's jump right in. There's a couple of things right now that you probably have realized. First of all, here's a big one. Non-QM loans are the future of real estate. They absolutely are. Non-QM, non-qualified mortgage loans. These are going to be what we used to call alt-doc loans. They're going to be the future of real estate. Here's the reason why. Your non-QM borrower, by the way, earns twice as much money on average than your agency or qualified clients. Now, why is this important? Well, because everybody in every major metropolitan area has been priced out of the market. Everybody has. The median sales price for a house is approximately $450,000, even though prices are falling in most markets right now. Affordability is the big issue, the big conundrum in real estate. So for mortgage lenders, if you want to get people qualified, you have to find people who have money. People who have money are going to be your non-qualified borrowers. Now, who are these people? They're your gig workers. They're your self-employed people. They're your 1099 people. They're your, the owners of your small businesses. These are the people whose business we want to covet. Now, I've said this a million times before. I've got somewhere to the tune of 72 businesses right beneath me. I'm on the second floor in downtown Vacaville, and I've done it before, but if I were to go walk this area, I've got 72 small businesses. Now, what's stopping me from going into those businesses and telling them, hey, listen, I'm a specialist when it comes to self-employed borrowers. I'm a specialist when it comes to 1099 borrowers. And here's the cool thing. When you have 1099 borrowers or self-employed borrowers, and real estate agents, listen up too, you're not only going after the business of that business owner and their database, but you're going after the business of the people who go to that restaurant, who go to that coffee shop, who go to that nail place, the Pilates place, whatever it is. Because everybody who goes into these businesses that are successful because they're still there are people who are considering buying homes. So when you work with a business owner, you're also picking off databases. So loan officers right now, like seriously, you have to become fluent in the language of non-QM. For example, the company Angel Oak, they came out with 9 new products. 9 new changes that are unique that are going to get more self-employed people into these type of mortgages. But here's the big kicker. If we go look at 2021, we saw a 14% increase in non-QM deals. 2002, it went up 15%, 2003, 16%, 2004, 37, subsequently 44, and 48%. Where do you think that number is right now? These are the people who are buying homes, and this is where the business is. I always say this, if you want to catch fish, you got to go where the fish are at. I'm going to go to a stocked pond. Right now, that analogy holds true for your non-QM borrowers. And real estate agents, listen, talk to your loan officers and find out like the broad parameters of what these type of loans can do. Because when you're out there talking with your sphere of influence, you might talk to somebody who feels like they can't get a home, but if you have like a general understanding of what's going on with non-QM loans, then you're going to be able to have something that looks like a meaningful conversation, and it's going to give you enough ammunition to go ahead and pass these people along to your lender, and then your lender can go out there and, of course, look at qualifying these folks, and this is where we can get their databases. So non-QM loans, again, guys, are absolutely huge for the market. Oh, and when we're talking, I'll tell you this right now, when we're talking about investment loans, when we're talking, about second homes, most of these loans today are going non-QM. Now, this is a big distinguishing point because in years past, we would do conventional loans, your standard conventional loans as a second home or as an investment property. And what we have on these things are called loan level price adjustments. In other words, what we do is we say, okay, here's your primary resident pricing, and then we go to our matrix of loan level price adjustments, and it will say investment loan, add 2%. 90% loan to value, add 2%. And credit scores between such and such, add whatever it is. Ratios above 38%, add such and such. And by the time we're done adding up all of the additions to our standard rate, we're going to find that that rate could oftentimes be in the tens. And what that really tells me is right now, conforming loans, agency loans, your conventional loans, they don't have a huge appetite right now for second homes. They don't have a huge appetite for investment loans. And when you look at the state of Florida and you look at, like Arizona and you look at Texas, these areas right now in the country are really suffering. Now, why are they suffering? They're suffering because these are areas, not so much Texas, but always when we have like a recession or a kickback, these areas are always hit first, because what happens is all the snowbirds go over to Arizona, and all the retired folks over in New York, in Manhattan, where do they go? They go down to Florida. So there's a lot of investment properties. There's a lot of second homes in both of these areas. And what happens is people let their second homes or their investment properties. We're seeing it right now with Airbnbs. Airbnbs are getting slaughtered right now. Everybody who is speculating and buying Airbnbs, those properties are the reason why we're seeing a downturn, especially in these markets, because these are the areas that people go. But anyways, because of these reasons and unforeseen reasons, our conventional loans, they don't have a whole bunch of appetite for doing investment properties and second homes, and as a result, we see it in a higher rate. Well, I call them exclusionary loans because they're trying to find a way to disqualify you. I call non-QM loans inclusionary loans. These are loans that they want to do. And with our non-QM companies, they can actually manually underwrite these files. And what that means is they don't have to go to an automated underwriting system and whatever the computer spits out, that's what you have to follow. They have an actual person who's looking at the deal, and if it makes sense, they can oftentimes go ahead and do it. They're inclusionary. They want to close these loans. And because of that, what they're doing is they're making their pricing more competitive. So non-QM loans, when it comes to second homes and investment homes, is a really great place for you to be. Now, with that said, I want to get to my second point. I live in Northern California, what would be considered a high-cost area. And all of my borrowers who've been in their house for over 4 years, they still have equity. In spite of the fact that we have a slight downturn, they still have a ton of equity. I was looking at listings down in Houston and between Tampa and St. Pete's in Florida, and I was looking at some of these properties. You can get a house for $250,000 that was built in the last 2 years. That's a 3-2 at about 2,000 square feet. It would be an ideal investment property. Yes, I understand people are scurrying from these markets, but as Warren Buffett says, you buy when people sell and you sell when people buy. Well, everybody is selling in those markets right now. They're depressed. You can go ahead and get a king's ransom price on a lot of these properties for investment properties. And I would go over there to like somebody in Northern California where I live, and I would go to my database. I would show them 5 properties that are down in, say, Houston, Texas, or in Tampa or St. Pete's. I would get a rental rating on these things to find out what rents would go for. So say rents would go for $2,400. I'm going to go to my database and say, okay, you could get $2,400 on these things. But what I would do if I were you is I would charge $2,000 instead of $2,400 and guarantee that you're going to get that place rented out because you're going to be below market and it's still going to be cash positive. Why is it going to be cash positive? Because what we're going to do is a DSCR loan on these things. And a DSCR loan is where you don't have to qualify the person based on their income. It's how much money are you putting down on the property, and is that property going to positive cash flow? DSCR loans are all the craze, and of course that's a non-QM deal. I'm going to go to my clients and say, you don't have to buy an investment property next door. You can go ahead and get one for a quarter of the price that you would pay for a house here. It's going to be cash positive, and of course when the market turns, you're also going to be gaining equity. In the process of doing this, you're going to be able to double your real estate holdings. Now, not everybody in my database is going to say yes to this, but the smart ones are going to do it because it makes sense. So again, when we're looking at where our market is, I always say we have to read the tea leaves of the direction the market is going. And right now the tea leaves say this would be a great thing for high cost area real estate agents and loan officers to do. A loan officer out there, go call a real estate agent in St. Pete's. Go call a real estate agent in the DFW area. The Austin area is getting beat up right now too. Houston is getting killed right now, and Houston's the 3rd largest market in the country. Go find a real estate agent, say get a rental rating on 5 entry-level properties, and let me go ahead and bring you a buyer. Every real estate agent in the country is going to say yes. Because here's the thing. 3 years ago, the greatest commodity that we had in real estate was a listing. Because we had a lot of buyers, we had a lot of people who wanted houses, and listings were scarce. 3 short years later, that's reversed. A listing means nothing right now. The greatest commodity in real estate is a ready, willing, and able buyer. Now, this would be a great strategy because here's the deal. Some of your people in your database are going to say yes, right? Now, birds of a feather flock together. People with a 580 credit score hang out with people with 580 credit scores. And people with 780 credit scores hang out with people with 780 credit scores. I'm just saying that tends to be my experience. So the ones who say yes, what are they going to do? They're going to become an outside account rep for you, and they're going to talk to their friends. And some of their friends are going to say, yeah, that sounds like a good idea. And here's what they're going to do. They're going to say, go talk to Brian. So again, this becomes a holistic approach to your business and a way to make it through tough markets. So if you're a real estate agent or a lender right now, and you're having a hard time, with business, and a lot of you are, this would be a great and simple strategy to work on right now. Again, working with my small businesses, picking off their databases, helping folks who feel like they can't be helped. It's amazing how many lenders and real estate agents are unaware of the absolute incredible benefits of doing non-QM loans. And we have the perfect market for these right now, and you guys have the perfect group of folks who would benefit both small business owners and your past client databases. So if you work these two strategies, you'll definitely go ahead and find success out there. So give this one a shot. Okay, my second point I want to bring up to you guys is, I will tell you this. How bad is the market in Houston, Texas? And this one tripped me out. One of my marketing tools I have is I use something called MoveTube. And MoveTube gives me access to every listing and every real estate agent in the country. And I can go out there and find out which real estate agents, have the most listings, which, what they're doing, what their average sales price is, where their listings are. I have all access to their listings too. It's really, really great information from a loan officer's perspective. That information really helps me build my business. But say in my area, I'm looking at my area, the top real estate agent in my area has 122 listings. That's a crazy high number. A couple of years ago, the top real estate agent would have had 7 listings. That's how much our market is turning. 7, 122. Okay? The number is extraordinary. The next one has 84, 84, 82, 68, 68, 66, 52. Big numbers. The market is certainly on the move. We are definitely in a buyer's market. But I'm in an area that, are we a little depressed? You bet we are. Houston, Texas, the top real estate agent out there has nearly 2,400 listings, and I am not kidding you. Now, you might ask yourself, how is a real estate agent going to deal with 2,400 listings? I have no idea. It makes no sense to me. They better have a big team. They better have 50 real estate agents, and they're putting all the listings under the name of their broker. That could be the case, but that shows you how different the market is. Now, if I go down in my market, say 50 places or 30 places, the 30 highest listing agent in my area is going to have like 5 listings. If I go down the same 30 places in Houston, Texas, that real estate agent is going to have 300 listings. Now, when you have that many listings, it's a simple case of supply and demand. That means if we have excess supply and, for the demand in your area, that means one thing, that prices are going to have to come down. And those numbers, by the way, I lied to you. The top agent out there has 2,142. The second one has 992. The third one has 847. The fourth one has 759, 570, 402, 386, 363, 354. Again, guys, the numbers are nothing short of staggering. And here's an example of a property that you could purchase out in Texas. This is in Houston. This is actually in Conroe, Texas. The property is 12123 Ridgetop Drive, Conroe, Texas. You could look it up. It's available today. Zip code 77304. It's a 2-story, absolutely beautiful, brand new house, 3-bedroom, 2-bathroom, 2-car garage. New house, cute front porch. It's going for $274,000. And do you think you might be able to get a little money off that $274,000? You bet your butt you could. You could probably offer that. You could probably offer $250,000, and they'd be thrilled. How'd you like to buy that house and turn that into a rental? How much money could you get for that property? Well, let's ask our Texas real estate agent to do a rental rating on that to find exactly out what that's going to be. Me, the loan officer, is going to run a DSCR and see if we can cash flow. And if we cash flow on day one, it would be a very, very good idea. And think of this too. A lot of folks who are selling their houses, I have a client like this right now. He's selling his house because He's strapped. It's remarkable how many people are strapped. Car repossessions are going through the roof. 30, 60, and 90-day lates on cars are going through the roof. Bankruptcies are going through the roof. The reason for it is simple. People have run up their credit cards. We have record high debt. We have 1.3 or 1.4 trillion dollars in debt, and that money is going to be tied to the Fed fund rate. And as we know, the Federal Reserve, Jerome Powell and the boys, they've decided that they're not going to lower the Fed fund rate. It went up by 5% over the past 2 years, and Jerome Powell came out today and said, you know what, I'm kind of concerned about this inflation thing, and I think what we need to do is keep rates steady where they're at right now. In other words, the record high interest rates, which your average interest rate on a credit card right now is 28%, with our record high revolving debt right now, means more people are going to be falling into this category. And what that means is people are going to be selling their houses, realizing their equity, going into a rental, and live to fight another day, which, by the way, is a great option for a lot of folks right now. What you want to do is sell high and buy low. You go get into a rental for a couple of years, not a bad idea. But what that means is rental demand is going to go up as more of these houses come on the market and more of these houses are sold. So taking the strategy that I just shared with you, that's going to be with non-QM DSCR loans, is a great, great idea. And if you have any questions about this, just feel free to put it in the comments, and I'd be more than happy to go ahead and answer those. Okay, let's move on to my next topic. Give me a second here. I'm just running through them. Okay. Do I want to go over this? I don't know if I do. It's what we're talking about is the rate index. We saw rates going in the right direction year over year, and this is going to frankly, this is from last week, and we've seen rates jump up a little bit. If we look at our 30-year fixed rate, the low we had was 6.11, our high was 7.3, and that's on a 30-year fixed. We are 0.12% lower than we were a year ago. On the 15-year, we're 0.27 lower than a year ago. On our FHA loans, we're 0.14 lower than a year ago. Jumbo loans, 0.27. And our 7 and 6 year ARMs are 0.66 lower than they were a year ago, and our VA are 0.14 lower than a year ago. So even if people are complaining about rates right now, you have to understand, interest rates over the past 40 years, the average rate has been right between 7 and 8%, and we're trending in the right direction. Actually, I do want to talk about this for a second. There was a study that I saw recently. Now, we have a lot of rate prognosticators. There are people who are rate experts. I know where rates are. If you knew the direction rates were going to go, you wouldn't be talking about rates. You'd be an investor and you'd be filthy rich right now. Now, the reason I bring this up is there was a study that came out, and the study was the result of FHFA's belief on interest rates, and FHFAs who hold Fannie Mae and Freddie Mac in conservatorship. It was the economists at Fannie Mae, it was the economist at Freddie Mac, it was the economists at the United States Treasury, it was the economists at the Federal Reserve. And what they did is they blended where we thought rates were going to be by the end of 2026. Now, if there's anybody who knows the direction rates are going to be, it's the ones who can directly influence the direction rates are going to go, and that these are precisely the agencies who can do it. So if I'm going to believe anybody from the bottom of my heart, I'm going to go to the people who can actually influence rates, these folks. And it is the belief amongst all of these agencies that we're going to see rates probably somewhere in the mid-5s over the next 2 years. So even though we've seen a spike in interest rates over the last week and a half, and we might even see a higher spike, I don't know. But if you believe the people in the know, it will eventually start to taper down. And as we know, the great saying is, everybody likes to talk about it, you date the rate, you marry the house. And, is buying a house in this market a good idea, Brian? If you're telling me that home prices are going to go down, well, yeah, it is a good time to buy a house right now. If you can positive cash flow on a house today, and you plan on holding onto that house long term, then yes, that is going to benefit you. Because one thing we've seen, and I would love to be able to show you the graph, but if you look at values of home, even the 2008 recession, it goes like this, bloop, and here's the 2008 recession, bloop, bloop, and it just kept going up and up and up. It was a small bump in the larger scheme of things. So real estate is always a good idea if you're going to, and if you have the ability to hold on to it long term. So yeah, buying a house today is always going to be a great point. And again, here's the headlines today on CSNBC. It said Fed's pal cautions about higher long-term rates as supply shocks provides policy challenges. Supply shocks, the tariffs. Supply shocks, the tariffs. Well, the last I heard is we just had negotiated a positive turn of events with China. We were paying 30% on tariffs going into China. They were paying 20% on tariffs coming into the States. We've turned that around. Now it's 30 us, 20 them. Or excuse me, now it's 20 us, 30 them. In other words, that's a 20 point shift. We made $13 billion off tariffs. And did you know this? We actually had a balanced budget for the first time this last month since Bill Clinton was in office. That's a fact. And it all came from tariffs. Now, has supply been an issue? Are prices going up? Well, no, they're not going up. Inflation is at 2.4%. It's the lowest it's been in the past 4 years. Now, the Fed target rate for inflation has been 2%, and the Fed has been trying to manipulate the numbers of inflation by making things more expensive for you. Now, here's what's happened. The Fed goes and raises the Fed benchmark rate from 0.05 or 1%, and they raise it up to 7% over a very short period of time. Now, this is going to affect how you borrow money on everything outside of mortgages. Now, the Fed has the ability to affect that by buying mortgage-backed securities and putting them on their balance sheet, something the Fed also says they're not going to do. So what the Fed is doing is making things more painful for you so you don't buy more stuff. If you don't buy more stuff, then the supply of stuff goes up and the price comes down. That's the idea. It's kind of like chopping your arm off if you have a hangnail approach to the economy, as far as I can see, because I don't see this as being wildly positive. And the truth of the matter is, over the past 4 years, this has failed miserably. We hadn't seen anything affecting inflation over the past 4 years with any of the moves that the Fed made. Now, the reason why the Fed did this is in the 1980s, when the last time we saw hyperinflation, we had a Fed chief named Volcker, and he went from like 4% to 13% with the Fed fund rate, like over the course of a month and a half. It was the biggest, largest, most drastic move we had ever seen. And it was funny. Somebody actually asked him, "Do you think this is going to work?" And he goes, "I have no idea, but I'm going to stay the course." In other words, he goes, "I don't give a shit if it's working today or not. I'm not changing my policy." And everybody went, "Oh my God, this guy is crazy." Everything got expensive overnight. And you know what happened? The perception that this guy was nuts and this was going to get even worse, people decided it was a better idea to not go out there and, conspicuously consume things. They held on to their money, and, more supply came in, and of course inflation went down. And that policy was so effective that we have not seen inflation over that 40-year period. So Powell is trying to follow what Volcker did in the 1980s, but here's what he did. He half-assed it. Back in the 1980s, Volcker just didn't care. He was a honey badger. If you've seen the video, he was a honey badger. He just didn't care, right? Powell, a little bit softer, says, "I'm going to be Volcker, but I'm not going to be quite as committed." And he wasn't as committed, and it didn't work. So the idea is make everything more expensive and painful for you, so you change your spending habits. Didn't work. Now, what did tariffs do? Honestly, think about this. What have tariffs done? People are, and the news is like, especially the people who hate our president right now. You go to any news station, they're like, "Oh my God, tariffs are going to be terrible. You're going, 125% tariffs, on everything coming in from China. The price of your phone is going to more than double. Everything's going to go through the roof. Buying a car is going to go through the roof because the cost of steel, framing, lumber from Canada, everything is going to go absolutely haywire." And you know what it did? It did exactly what Volcker did in the 1980s. Tariffs did what Powell failed to do over 4 years. We were so afraid that tariffs were going to absolutely destroy this country that everybody quit spending money. And you know what happened? Inflation tanked. We're at 2.4% right now. The truth of the matter is, as far as I can tell, I think Powell could lower rates right now because inflation is low and there's still fear about what's taking place with tariffs, even though we have negotiated better deals, more reasonable deals on tariffs with our largest trading partners. We look at Korea, We look at China. We look at Mexico. We look at Canada. We've actually accomplished what a lot of people half this country thought was not possible. So when it comes to framing timber or shingles, I read somewhere that nearly 80% of what we use to build a house, we import from Canada. And so the price of those is not going to go up. And right now we've got greater supply in properties, which means the price of homes it's happening right before our eyes. The price of homes are dropping in every major metropolitan area. Now, from a lender's perspective, a buyer's perspective, and a real estate agent's perspective, everyone's talking about this like the sky is falling. We're losing trillions of dollars in equity. From a lender, buyer, or real estate agent's perspective, professionally and very selfishly, I love what's going on. I think this is great because, well, one, I think ethically we should be able to afford to buy homes. We can't do that right now. We have not been able to do that. We're killing the middle class. If you can't buy a house, if you can't build wealth, if you can't build equity, I think that's an unfair position for a working family to be. I've done a lot of traveling over the past 20 years, and every time I would travel into a city, I always looked up like, could your average civil servant buy your average house? Like, could a cop buy a house? Could a nurse buy a house? Could a garbage man buy a house? That type of thing. Because I think if you're servicing a community, you should be able to buy a house. When I started this 20 years ago, in most areas, it was reasonable. Yeah, you might have to have two incomes, but you could just overkill it with two incomes, and it'd be tight with one income, but you could certainly do it. Now, it's absolutely not a chance anywhere in the country, and I think that's a travesty. Now, that's ethically. Now, on a personal basis, I like this because I'm going to have more qualified buyers to go ahead and buy these houses because prices are coming down. And now more folks who can't buy a house today are going to be able to buy a house tomorrow. I've always said this before. If I can't afford a ticket to the concert, I don't give a crap who's playing. And that's how a lot of people feel right now. If I can't afford a house, I'm not even going to think about looking at buying a house. What's the point? Well, now that narrative is changing. So people in the real estate and lending industry, we have to start talking about this. We have to start changing the perception of affordability. We don't need to look at this as a bad market. We need to look at this as a positive change of events. It's going to be good for us, and it's going to be great for some of us. It's going to be great for those who can go out there and actually afford to buy a house. How do you feel about that? Seriously, how do you feel about that? Now, the ones who are going to be pissed off are the ones who are homeowners. But let's think about that for a second. If you bought a house 4 years ago, you've realized twice as much, twice as much equity as you ever in a million years thought you were going to get. So let's say we hack off half your equity, that funny money that's not real. Are you going to say to yourself, well, you know what? I just got screwed on this thing. No, we took away the additional money that no market has ever seen before. It's called a price correction. And you're still going to walk with a ton of equity that you otherwise wouldn't have had you not buy that house. So we're going to move from a place of unrealistically high gains to reasonably high gains. So even though you're going to feel like you're screwed if you own a house, the truth of the matter is you're getting what you thought you were going to get the day you bought that house. That's the truth. That's the fact of the matter. And there's nothing wrong with that. And by the way, if they lose half that equity in that property, that means we're going to allow more folks to go out there and buy these homes. Now, you've probably also heard that FHA, that we have a whole, here's a crazy number. There was like 500 people on FHA loans who had never made a payment. Do you know how many of those 500 people who never made a payment, do you want to know how many of them actually got foreclosed on? 9. That's a real number. 9. In other words, FHA found a way, HUD and FHA found a way to keep them in the houses. Now, how would you like to live in a house for 2 or 3 years without ever making a payment? That's a pretty good gig, isn't it? That's a pretty darn good gig. Well, that policy is gone. In other words, you're going to have to start making your payments, or those properties are going to get foreclosed on, bringing more inventory to the already high inventory numbers that we currently have. The VA is following the same course. The FHFA is following the same course. They're starting to enforce their foreclosure policies. And this is a great thing too, because think about this. If you have people who are living in houses not making their payment, do you think they're paying their tax bill? No, they're not paying their tax bill. In other words, they're depriving communities of money that pays these civil servants that mows the grass in your parks, your community parks, that pays for your library, that pays for your teachers, that pays for your first responders. They're depriving your community of desperately needed money to make your community as great as it is. I would rather have somebody in that house who could take care of that house, who's also going to pay their taxes on that house. Now, I feel bad for people who are getting foreclosed on. I honestly do. But pragmatically looking at this whole thing, I think this is going to benefit everyone. Again, as a real estate agent right now and as a lender, the additional inventory that we're going to have is going to be more loans for us and more listings for real estate agents. And this is a good thing. Now, we're coming out of a market where you couldn't influence anything. I can't influence interest rates. I can't influence policy. I can't do that. But with more buyers on the market, I can influence that person on the other side of the table. And I can convince some people of making the right decision. In fact, I just had this conversation with a client, and I said, hey, listen, there's a couple of things that you could possibly do. We can see if we can keep you in the house. But after talking with him for about 45 minutes and just talking about the direction of the market he thinks it's going to go, he goes, no, Brian. He goes, I want to sell this thing right now. He goes, I want to hold on to my equity. I want to sell this thing right now, and I've got a plan. I'm like, cool. So I called up my real estate agent, and I said, hey, listen, I got some guy who wants to list right now. This is happening right before our eyes, and this is a very important distinguishing point. Powell said, talking about this, he said, we may be entering a period of more frequent and potentially more persistent supply shock, a difficult challenge for the economy and for central banks. Okay? Higher real estate may also reflect the possibility that inflation, which by the way is low, inflation could be more volatile. It's 2.4%. We hit your goal rate. Inflation could be volatile going forward than in the inter-crisis period of 2010. Again, a crazy point. And by the way, chiming in on this today was J.P. Morgan Chase's CEO, Jamie Dimon, who says his economists see the possibility of a recession still going forward at about 50%. Specifically, Dimon said he would defer to his bank's economists who put recession odds close to a toss-up. Michael Ferroli, the firm's chief U.S. economist, said in a note to clients on Tuesday that the chance of a recession outlook is still elevated, but now roughly slightly below 50%. Who the hell knows that? I mean, who's the captain of these boats? Is it Jamie Dimon, or is that fellow who was running the Titanic? I'm not sure personally. Anyways, these are a couple of things that I think might be able to help you if you're a loan officer, real estate agent, or even a client. Again, make sure you hit me a like. Any questions that you have, put them in the comments down below, and we're going to be bringing you more lives over here. And make sure you check me out over at Mortgage Shots or the National Real Estate Post, where you can subscribe to get my daily videos. Of course, it's free of charge. And here's one thing I can say that other people won't say. I won't sell your information to anybody. If you sign up for it, you'll get a daily video in your inbox, 5 minutes to tell you what's going on in real estate, maybe a little sales nourishment, and put a smile on your face. With that said, my friends, if I haven't met you before, it's nice to meet you. And for those who know me, good to see you guys again. And I look